Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Sorry. Sorry, I'm waiting for the computer to boost up. This is very slow. Yeah, you guys should tell ANU to upgrade the computer because you pay a lot. They spend a lot, yeah. Not on me. All right, so finally, that's probably not something I want. This is so slow, it's frustrating. Okay, good. Where's the other one? This one crashed. Okay. So let me actually, do you want to, this water thing is incredibly slow. Here we go. Now you can download the lecture slides. Good. So we actually talked the most of sort of the core materials by now, right? So you've seen how to do the investment allocation, how to sort of find the factors, how to use the factors, all these things, right? In particular, for example, if you have the multi-factor model, you can sort of look at whether the founder performance actually have alpha or not have alpha. But most of these things are actually, we talk about in terms of portfolio investment, right? So which means we don't have really actual information other than what the market tells us, right? So what we look at is basically the distributions, right? So it's the mean or conditional mean or the variance, all these distributions that can sort of be easily found out of the stock prices, stock returns. That's sort of the common knowledge, right? So today we want to talk about what happened to the information. If you have information, then what can you do? Right, so in particular, let's first talk about the event studies. So the event study is one of the sort of the most useful tool that's coming out of market efficiency test. There's a particular kind of hedge fund that's dedicated to the event study. Right, so I think about 10 years ago, maybe more, like 20 years ago, There's two professors in Chicago, right? So they were looking at the merger acquisitions. Right, so by now we know the merger acquisitions actually usually is good news for the target, but not necessarily the good news for the acquirer, right? So good news for the target, that's they use precisely this abnormal return approach to examine that. And they find something. As I told you, sometimes you don't want to publish paper, right? So they actually quit their job, set up the hedge fund. So their hedge fund is now one of the biggest to do the macro and event-driven hedge funds. But their starting point is look at the event that's merger acquisition. Okay? So event study is sort of everywhere. A lot of students, given their PhD or master students, when they graduate with an economics or finance degree, sometimes they actually do the consultings, right? And sometimes they do litigation consulting. So a lot of what they do actually is using the event study approach. You'd want to advise the judge, right, whether this event, for example, CEOs buying their own share, is harmful to the stock shareholders or not. So there's a lot of sort of quantitative-based evidence that litigation does requires. So as we have seen before, the market efficiency test is basically testing this hypothesis that the expected abnormal return is 0. So what is expected abnormal return? Abnormal return is just your realized return minus your conditional return given some model. Right? So the challenge there is to sort of figure out the giant hypothesis problem. Are you actually sure your model for expected return is actually the correct one? Right? So if that's true, your abnormal return, although can be positive or negative in any given period, but taken the expectation, or on average, they should be 0. Right? So on the other hand, that was testing the efficiency of the market. But on the other hand, if you can assume market is reasonably efficient, then you can actually detect whether the market has information or not by calculating the abnormal returns. Right? So you can have this valuation effect, which is basically calculate the difference between the return that's realized minus the return that given the information of the model. And that's basically the difference between the return that the event happens and the return that events do not happen. Right, so by looking at abnormal returns, you can actually say something about the event. So as I said, there's lots of information events on the market, right? So for example, firms release a lot of information to the market, most prominently the earning release, right? Each quarter firms file their earnings, and annually they also file the 10Ks, the annual report, right? And there's information like when the firms pays a dividend. So the question is whether pay dividend has no effect, or it's positive effect, or it's bad news for the market. MMAs, insider tradings, right? So that's one of the area I do research in. So insider tradings, because the insiders, the managers and the board members, these guys actually know more than the market do, right? So when they actually trade, market can actually inform some information from their tradings. And this information can further affect the market price. Right, so for example, in China, if you look at their, I think this is called bulk trading in China, 大宗交易, right? So in bulk trading, a lot of the trading is done by large shareholders. They are classified as insiders, or by the managers because they cannot trade their own stock at the beginning. There's a lockup period, right? But when the lockup period passed, they can sell their shares very quickly through the bulk trading, right? So although bulk trading doesn't go into the main exchange system, but their trading actually affects the returns in the market as well. So there's lots of things that's happening in the market that sort of you can use the event study approach. So let me actually use some data. So to illustrate, this is the daily data, I think from 2011 to 2013, daily return data. And we also have to have the market data, also daily, right? Then I can just merge the two data and to calculate the excess return, which is the firm's return minus the market return. Here is the evaluated return. All right, so let's use Apple as one example. Apple is Permico equal to 7. All right, so I just got to the Apple, and I want to look at the Apple stock returns that's between 2011 December 25th and 2012 May 25th. So you can see there's like a bump here of the stock returns, and some volatility and a bump here of the stock returns. So if you look at this, this is 2012 January, right? And this is 2012 April. So the difference between these two is 3 months. We'll say, oh, what is this? This must be the earning release, because you release your earning every 3 months, every quarter, right? So if you go back to look at the earning release date, actually this matches up pretty well with the earning release date. So beginning January, you release the earnings that's up to December last year, and then April you release earnings of the first quarter of 2012. So if you look at the earning release dates, 2012, April 24th, that's the earning release date, and January 24th, that's also the earning release date. Right, so if you look at these two dates, January 24th and April 24th, these two dates actually matches up with the stock return bump you looked here, right? So we can be sort of reasonably sure this stock abnormal return fluctuation is due to actually earning releases. Then if you look at this chart, you have EPS, that's the earning per share, right? And then you have surprises, right? So if you look at here, compared to the last earning report, the EPS increased by 97 cents, right? From 1.01 to 1.98. But the earning surprise, it says it's only 0.54. Right? And the April one Remember, this April one is the one that has huge volatilities, right? The April one, if you look at quarter by quarter, that's from 1.98 to actually drop to 1.76. That looks earning becomes worse, right? Because January 2012 is sort of historical earning for Apple. So this earning looks like getting worse, but the earnings surprise says it's positive 0.32. Right, so this actually begs the question, or illustrates the question that what is really the information in the market? Right, so if you look at the information as only to compare to the last earning release, you'll say the earnings surprises are actually much lower than the numbers show here. Right, so so there was a numbers here, which is 0.54 and the 0.32 is actually higher than the difference we saw. What's their benchmark in surprise? And what should really be sort of the additional information in the market? So you guys know how the earnings surprises are actually calculated? No? Nobody knows? So what's the earnings surprise? Earnings surprise is your current earning minus something. Expected earnings. But how do you get expected earnings?
Historical average.
Well, one way is to get a historical average, right? But as we said, you can actually do better. Analyst forecast. Right? There's an analyst in the market that's sort of constantly updating the information about the firm. Right? And a lot of the time they are actually doing the forecast of the EPS continuously. Right? So if the analyst already forecast the EPS, for example, to be 1.6 something, then that will be the benchmark because that's something market already knows. Right? Not only just the information that historically happens, it's only the information that's sort of provided by the analyst. In the US market, the analyst is understood to actually have information between the periods firm actually release the information. It's probably a different story in China, I don't know. Because there's this news of this analyst. You guys don't know this news? There's a female analyst that's having this dinner with whoever is trying to vote, to be sort of the top analyst, that's actually connected to the compensation of those analysts, right? There was someone actually did the research in Chinese market, and sort of saying the enumeration of the analysts in China is not very connected to the forecast accuracy of these guys. Just that you know. Okay, so the moral of the story here is that whenever you do something like analyst event study, you should be sort of be aware, what kind of information I'm talking about, what really is the benchmark, what really is the new information I'm actually trying to get, right? So over the years, students sometimes do research in this kind of area, right? So for example, I remember this student who wants to do something about, for example, for example, they have in the Olympics or sports events, there's advertising during the time, right? But what you expect, for example, during the event, during the Olympics, this sports event that has some impact on the stock prices or the stock returns. So the first thing you need to think about, what really is the information here? Well, would the actually market know the sponsorship when the Olympic is in session? Or do the market already know long time ago when they signed the contract? Right, so if you are actually someone who's sort of in charge of millions or billions on the market, you already are paying attention to these informations. So these will not be new information when the actual sports event is happening. It should be the information only when this news comes out about the signing of the contract. So you should be aware of what's the information event. The next one, the timeline. Looks like I don't have a good. That's better. So let's say event happens in a day, right? So this time 0 is when event happens, okay? Now we want to set up a window that's to sort of estimate what happened during the event. So the first thing you determine is actually to determine an event window, which is from tau 1 to tau 2 on this graph. All right, so some of you may ask, why if event happened at time 0, why don't you just look at time t0? Well, usually when something happens on the market, a couple things can happen. One is there are insiders, right? So for example, the managers who can actually be trading, or if he doesn't trade, he can tell someone to actually be trading, although this is not lawful, but nevertheless, someone could have information before the actual event happens. So that's why you set it usually a couple of days before, -1 or -2 days. Sometimes people use up to -5 days before the event to set tau 1, right? And on the other hand, when the event happens, not everyone in the market immediately realize what was happening. They need sort of time for the information to actually to propagate through the market and information be processed by the market participants. So sometimes you can have delayed reactions. So although this is not instantaneous efficiency, but by and large, market can be still efficient over a window. So that's why you set a window that's around the event date 0 to be what's called the event window. Remember, for us to actually say something about normal returns, right? Usually we also need to say what's the normal returns. So to estimate what's the normal return using the model you have, you need an estimation window. So this estimation window is between this big T0 and the big T1. So this is estimated in the period that's before the event window, right? Because this is what the return is supposed to be looking like before the event happens, okay? You will also notice a lot of time there's a gap between this T1 and tau 1. Okay? So this gap is such that your estimation of the normal return will not be contaminated by the information in the event window. So you can really be sure what the normal return actually look like. All right, so that's the estimation window. Also, sometimes you also want to sort of look at the long-run effects, right? So, for example, in IPO studies, you not only look at what's called the IPO underpricing, which is the first day return of the IPOs, or first couple days return of IPOs, right? You also want to look at the long-run performance of these IPOs. If you want to look at the long-run performance of these events, then you need what's called the post-event window. That's from big T2 to big T3. Right, so with these event windows, now we can carry out our estimation of the normal returns. So for you to estimate the normal returns, as we already said, you need some kind of model, right? So most popularly, similar to CAPM, because the coefficient is the same, people usually estimate a market model, or you can estimate the CAPM model, then with the intercept coefficient, that'll be the same. But usually people estimate the market model, right? So the individual return equals to some constant plus the beta times the market return, subject to some errors, right? Then use this market return, then do the predicted returns as your normal return. People has also sometimes been using the mean return model, which says the individual stock return is just some sort of constant mean plus some random errors. All right. So as you can see, this mean return model is really just the market model with beta equal to 0. All right. And even more simplistic model will be a market adjusted return model. So market adjusted return model measures abnormal return as your mean return, your individual stock return minus the market return at the same period. So this, as you see it, is the excess return we have already seen. Right? So if you want to use sort of a simplified model, I'll actually suggest you to use this market adjusted return instead of constant mean return. Why is that? Because market adjusted return is really just the market model with beta equal to 1. Right? So if we beta equal to 1 here, then Ri minus Rm is just Rphi plus some error term. And we are interested in what the Rphi is on average. Right? So this market adjusted return is just the market model with beta equal to 1. And if we have many of the stocks and the stocks are diversified, we know on average beta should be close to 1. Okay, so this assumption is not too off if you're looking at a large portfolio of the stocks. Right? Of course, you can look at other factor models, such as Pharma-French 3-factor model, or the Carhart 4-factor model, which is the 3-factor model plus the momentum. Right? So there's no limit of sort of what kind of model you want to use, and increasingly people have two tendencies. One tendency is to use increasingly complicated model to estimate. Another tendency is to increasingly use the most simple model to estimate. And you will see at the end they are not very different. We'll talk about that. Okay, so with the model, now you can calculate the abnormal returns. So abnormal returns is calculated within the event window, so tau 1 to tau 2. And the abnormal return of any stock I in each tau in tau 1 to tau 2, that equals just individual return I tau minus the normal return you estimated from the estimation window. Right? So for example, the market model, you just have RIT minus the Fi plus beta I RMT, parentheses. And constant mean model is just return minus the constant mean. Market adjusted model is just return minus the market return. That will be your abnormal return at each time in the, or at each date, I should say, in the event window. All right, so let's use this, for example, with our data. Use the AAPL as the example. All right, so let's first of all set the event date. So event date, that's January 24th, 2012. And that's data number 266 in our data. All right, now let's set the estimation window. Estimation window, that will be, I set it from T minus 200 to T minus 15. So that will be the estimation window. All right, so 200 trading dates before, up to the 15 trading dates before the actual event, the earning announcement. Remember, in January 24th, the earning announcement is really positive. All right? So that'll be the data I have in the estimation window. Now I just want to fit into a market model and get the beta coefficients of this market model and use this coefficients to estimate the normal returns. Remember, the normal return should be calculated during the event window, right? So I need to calculate what's tau 0 and what's tau 1 first. So I set my window as 1 day before the actual announcement and 1 day after the actual announcement. So this will be a 3-day window minus 1, 0, plus 1. Okay? So within this three-day window, I get my data, I call it event. That's my window. And I calculate my normal return using the beta I estimated from the event window, from the estimation window. So that's the beta 0 plus beta 1 times the returns in the event window. That'll be my normal returns during these three-day windows. Right? Now my abnormal return is just my return minus the normal return. And I can see during this 3-day window, this will be 0.0144, next is 0.0148, then at the time t plus 1, this is huge increase of 0.054. Right, so by just looking at this abnormal returns, I have no idea of, does it mean this is significantly positive reaction? Or does it mean because there's some positive, there's some negative, does it mean there's no abnormal returns during the period? So what I need is actually to also get a distribution of the daily returns so that I can say whether this reaction of 0.05 is actually big or small. Right? And whether some of these fluctuations I can actually ignore. Right? So first of all, I need the distribution of the daily return so that I can look at whether this reaction in abnormal return is significant or not. Remember what our null hypothesis is. Under the null hypothesis is that the event will have no effect on the stock price, right? So the abnormal return itself will be still distributed normally with mean zero and the variance of the same as the estimated variance we have in our estimation window, right? Because we assume this variance should not actually change. So as long as our estimation window is large enough, we can use the estimates to actually approximate for the distribution of the daily returns in the event window. So in particular, I can look at, so this is actually variance. Let me look at here. I think I updated. Yeah, so I can calculate my sigma of the tau. That's square root of fit. Fit is the model I have in the estimation window. Dot residuals, so that will be residual of the model. Dot variance, so that will be the variance of my residual. So variance of my residual takes the square root. That's my sigma. Right, so this is the daily standard deviation. So the daily standard deviation is about 0.01. So given this daily standard deviation, I can calculate the t-statistic for each day of abnormal returns. Right, I have 3 days. So for the first -1 date, this t is not significant. Times 0 date, when the announcement, I think this announce is actually at the off hour, right? So it's actually, although it's an announcement, but you should probably adjust it. So this will be negative, not significant. But if you look at the time t+1, the market reaction is overwhelmingly significant. And the abnormal return is about 5%. Which compared to the standard deviation of 1%, that abnormal return is huge. Right, so this will be like 4 or 5 times your standard deviation. Okay, so that's my abnormal returns. But what I want is not just, is my return at each date in the event window is positive or negative, is significant or not significant. I want to say something overall about this event. Okay? So to say something, the overall aggregate effect of this event, I will be looking at this cumulative abnormal returns, which is calculated just by accumulating or summing all the abnormal returns up during this tau 1 to tau 2, the event window. Right, so each day I can calculate abnormal return, but I can add up abnormal return in each day of this window to get the cumulative abnormal return during this window. Right, so the cumulative return itself is actually easy to calculate. But what about the variance? Because we also need to know the distributions, right? So we know the variance, let's say the variance of stock I at each individual period is just VI. And you have k periods, tau 2 minus tau 1 plus 1 equal to k, so that will be k periods. Then the variance of your cumulative abnormal return, assuming market is efficient, which means the returns of each 2 dates are not correlated, right? So the variance of this cumulative abnormal return is just k periods times the each period variance, which is VI. Now we know the distribution of the cumulative abnormal return, CAR, of tau 1, tau 2. It's just distributed normally with mean 0 and sigma square I of this T1, T2, tau 1, tau 2, that's just equal to K times VI. So we know the distribution, we can do the test. All right, so usually this test is carried by the t-test. So simply with our simple example, you just sum up all the abnormal returns. All right, so you know the cumulative abnormal return is about 5.1%. Now the important thing is to calculate the standard deviation of the 3-day cumulative abnormal return. So you have the variance of each individual date that's estimated before times 3, that's the 3-day variance, and then take the square root. And with standard deviation, you can do the t-test. T-statistic will be just CAR divided by this sigma. And we see that t-stats is 2.39, and this is actually highly significant as well. Right, so here we can sort of conclude by saying that in January 24th, 2012, Apple released a very positive news about their earnings, and this positive news indeed have significant positive abnormal return during the event period. Market actually moves significantly positive in the event window. Right, so which is sort of matches with our hypothesis that the positive earnings have positive impact on the stock returns. Alternatively, so before that, we were using the market model approach, right? Alternatively, we can just use the adjusted return approach or the excess return approach. The cumulative abnormal return is just the excess return, then sum up, right? And you can, again, calculate the standard deviation and do the t-test. And if you look at this t-statistic and the CAR is about 5.22%. Remember before it's 5.12% with the market model, right? Now it's 5.22% with the excess return. And the T is also about the same, 2.27. So if you compare this market model result and the simple adjusted return result, you can see that both CAR and the T statistics are actually very, very similar. So that's the good news I was talking about, right? You will notice that the results you get from these different approaches are very, very similar. And that's a phenomenon actually studied in 1985 by Brown and Warner. They find out that in daily data and short windows, a simple mean return model or some other excess return model often yields results very similar to a more sophisticated model, such as market model or 3-factor model or 4-factor model. And that's because with the short window and the daily data, the variations in abnormal return is not reduced, also the variance is not reduced by choosing a more sophisticated model. So the variance will sort of stay similar whichever model you actually use. So the main thing is the changes in mean of the CARs, and the mean of the CARs do not actually, in a couple of days, do not actually change depending on which model you use, right? So if you think about whether this has risk or don't have risk, beta equal to 0, beta equal to 1, or whichever they have multiple beta, this all yields similar results for your a couple of days of daily return data. So that's why if you read the papers nowadays, a lot of paper, so they will use two extremes, either use very complicated model or use very simple model, right? So if you're in the camp of saying, I need to do something sort of to the extreme of, to be sort of attractive, perfect, then you use a very complicated model, right? If you are someone that says, oh, I can just do something as long as this is good enough, you use the simple excess return model. Okay, so finally, what we talked so far, we use this example of one announcement by one stock of the earnings surprise, right? So one announcement in January 24th, 2012 of this one stock, AAPL. But what usually happens is that there are so many announcements of earnings, right? And with so many stocks. So most of the time we are interested in the sort of questions, for example, does this positive announcement have positive return effects, regardless of when it's announced, regardless of which stock it is, right? Then what we sort of want to sort of calculate will be for end of events. This end of the events can be by multiple firms at multiple times, but we assume each firm and each date of each event is actually distributed independently. Okay? So if that's our assumption, then we can calculate what's called the cumulative average abnormal return, the CAAR. The cumulative average abnormal return is just the average of all the abnormal returns, the CARs, of these independent end events. Okay, so instead of just looking at one event by AAPL, you can look at this positive announcement by IBM in the January, and positive announcement by IBM in April, and a positive announcement by Google in September. So you assume all these announcements are independent events. Then you can just calculate a mean of those CARs of each of the event. Okay? So if you calculate the mean, mathematically you know that this is the same as if you calculate the abnormal returns, not the CARs, right? So not this cumulative. You calculate the average of the abnormal returns in the window first, then you cumulative them across time. Right? Because mathematically we can take this 1 over n outside the summation or inside the summation, it's the same. Or intuitively you can say if you want to calculate the average across time and across firm, you can first calculate the average at each date across firm, then add them up. Or you can calculate for each firm, the cumulative return, then average them. It's the same thing. Right? So whether you do the average first or later will give you the same result. So let's do the example of announcing the dividend with an increase of 15% or more. Okay, because you have this MM series says the dividend doesn't matter, right? So you want to say, well, what if a firm announces a dividend that's increase the dividend by 15% or more? To limit our sort of sample size, I'll just look at the year 2012, right? And how I select data is to look at the difference, so this dividend amount minus the lag of dividend divided by lag of dividend, that will be greater or equal to 0.15. So this increase is about 15% or more, right? Then for each firm and each announcement, I just get the latest data, so it will be one firm, one date, one announcement. So I can just calculate the simple market-adjusted cumulative number of terms, right? So this CAR is just the rolling 3-day excess return sum with date 0 at the center. So this is centered, okay? And I also want to make sure this actually is 3-day window. So I calculate this count. I want this count to be equal to 3. And I want this dividend declaration date to be not now, to be not missing. That's because I have all the dates, right? But in most of the dates, if you look at data here, well, it's not easy to see from here. If you look at the data in most of the dates, you don't actually have announcement, dividend announcement, or dividend declaration. So you only want those cumulative sum of abnormal returns or excess returns during the window that there is actually announcements. So this is just sort of a programming trick. You also notice to be sort of absolutely correct, I need to be sort of have group by perm code here. So I need to sort of cumulate them by each perm code. Otherwise, because our data is stacked, 2 perm codes will have cumulative returns calculated wrongly, right? But this doesn't really matter because I ask this count to be 3, and I ask this announcement to be not now. So even if there's a wrongly calculated cumulative returns from one stock to the other, they will be ruled out during these 2 stops, during these 2 qualifying events. So in sum, what I have here is the cumulative abnormal return for each of those announcements, different firms at different dates for each of those announcements. So one firm, one date is one event, right? Now I can calculate the average of these, which will be CAAR. So CAAR, cumulative average of non-return, is just the CAR I calculate, and then takes the average, takes the mean. Right? And then I can do the t-test of this CAR, and you see that this p-value is really, really small. Right? So this CAAR of 0.7%, and that's 3-day return. 3-day return of 0.7% is not exactly small, right? Indicates that if you have earning announcement, the dividend announcement that's increase your dividend by at least 15%, such event across all your sample has positive impact on the stock returns. Right, so this is positive, your p-value is significant. So again, on average, earning dividend increase return by 0.7%, and this is highly significant, which means dividend is a positive signal of stock returns, contrary to what MM says. All right, so hopefully you already seen something that's in your corporate finance class, right? But how do they actually provide the evidence in the corporate finance class? You still need some asset pricing backgrounds in actually using the methodology. Let's take a break. Okay. Yeah, so what we talked so far is an event study in the short run. Usually you have daily data, and event window is from -5 to +5, or -3 to +3, or even smaller. So in that context, the cumulative model return is easy to calculate. You just do the sum. And the particular model doesn't really matter, as shown by this 85 paper. All right? But if you have long-run study, for example, if you want to look at this post-event window, what happens, right? And post-event window is like usually several years or several months at least, then it's more complicated. The main thing is that although as a pricing model, particular model doesn't matter in the short run, now in the long run, the asset pricing model will be very important because you have many periods, right? So any small mistake or small error you make will lead to big differences over time. Okay, so benchmark selecting becomes really important. The asset pricing model becomes really important in the long run study. In the short run, we use the sum of the abnormal returns to calculate cumulative abnormal return, right? In the long run, because we know over time return has this cumulative effect, right? So adding them up is no longer actually correct. So what you need to do is to calculate this called buy and hold, BH, so buy and hold abnormal returns, which is calculated as the product of 1 plus return RIT during the event window you look at, so t equal to t inside the tau, minus the 1 plus expected return given your model, and you take the cumulative product within the model. Right, so this buy and hold abnormal return actually takes the compounding into effect. Right, of course, if you sort of want to use this buy and hold abnormal return to calculate the short run abnormal return, that will also be correct. Okay, it's just that in the short run, because the compounding doesn't really matter in a couple of days, usually people just take the sum, right? But this is actually the correct formula for both long run and the short run. So if you compare this product, cumulative product with the cumulative sum, you know the major difference is actually in the arithmetic average, when you take the average, versus the geometric averages. Right, so if you compare this BHAR and the CAR, you will see that if CAR is really low, right, then BHAR will be sort of lower than the CAR. If CAR is getting higher, then BHAR is much higher than CAR. All right, so depending on whether you have really positive or really negative cumulative returns, the CAR will be actually performing much worse or much better than the BHARs. So only if your CAR is sort of close to zero, your CAR and the BHAR is actually not very different. So in any case, you want to use the BHAR for the long run. Right? It's also important to actually calculate this expected returns in the long run return accurately, because now you have cumulative compounding effect. Right? So for example, if you're looking at, for example, the abnormal return of the small stocks, right? Now you probably want to use the expected return of the pharma French small stock returns, portfolio returns, instead of just the market return, right? Or instead of some return you calculated from a market model. You want to use the predicted returns that's calculated from a three-factor model. Right, so this expected return is actually very model dependent. Yeah. But in general, we sort of understand less about this BHAR than we understand the CARs. So if you use the CAR, you can sort of, it becomes really standard, you can just use them. If you want to use BHAR, then you need to really think about your model selection and compounding of these issues. Okay, so far we talked about the abnormal returns given some information, right? Now I want to sort of switch a little bit gears to talk about, in theory or in models, how the information actually is incorporated into the stock price. Right, because so far we only talked about the distributions. We don't really talk about trading yet. So let's recall something we actually already see. Right, so I think this is already in your assignment also, right? So although the functional form might be different. So let's say you have individual that have CARA utility curve, constant absolute risk aversion. So you know this is exponential function, right? So let's maximize the expected utility, which is negative exponential function of e to the power minus AW, and A is your risk aversion. Right? And I here is for one person, individual person, so agent I. We can transform this maximization by using the log normal property. This becomes just maximize the mean minus half of the variance times the risk aversion, AI. Right? And the constraint is the same, which means the wealth next period, depending on your wealth investment in the risk-free asset and your investment in the risky asset. So if you invest XI in the risky asset, the payoff, because risky asset next period price equal to T plus 1, the payoff equals to PT plus 1. So the amount of money is PT plus 1 times XI. But your total wealth is WIT at this period, right? So your total wealth minus what you invest in the risky assets, that's how much you invest in the risk-free assets. And then times 1 plus RF, that's your payoff, total payoff, or total return. That's from the risk-free asset. All right, so now we can just solve this maximization problem, which I hope at this point is sort of standard for you, right? You set up a Lagrangian, do the first order condition. So if you set up the Lagrangian. Now you can just plug in the WT plus 1 into this maximizing function, so you don't really need a constraint. So this will be my what I'm maximizing, and take the first order condition with respect to xi, because xi is my choice variable. I'm choosing how much to invest in the risky assets, right? So the first order condition will be just expect the price minus 1 plus r times p last period equal to my risk version, ai, times xi times the variance of the price, so that I can solve for xi, which is our standard form. If you look at the top, that's the mean payoff, right? If you look at the bottom, that's the risk aversion times the variance. All right? So what we done here is to solve the optimal allocation in the risky assets, given what the expected price is, what the variance is. All right, so as you can see that, this is depending on excess return in expectation and depending on the variance in the price theory or the return theory, and depending on the risk aversion, but this does not depend on the household wealth itself. Okay? Now, what happens when you have private signal? Right? So for example, this is for each of xi's, right? And although we look at this expected PT plus 1, this should really be expect PT plus 1 depending on the information of this individual xi. Okay? So usually before that, we talked about everyone have the same information. Okay? So you have the same conditional expectation. Now, you can have different information for everyone, which we called private signal. Right? So let's use a very, very simple model just to assume each person, each individual can observe a signal called y tilde I of this true price PT plus 1, right, which we can write as y tilde I equals to this true price plus some random variable. So if that's the case, if we run the regression of this PT plus 1 on the signal yi tilde minus the mean of yi tilde, so this is the deviation from the mean for my signal. If I run such a regression, then the coefficient beta of this regression will just be the covariance of PT plus 1 with my signal y tilde it divided by the variance of y tilde it. So this is O standard, right? Because beta equals to covariance of xy divided by variance of x. Okay? So what is this covariance of PT plus 1 in the signal? We know this signal equals to PT plus 1 plus epsilon I. So this covariance equals to the unconditional variance of the price itself. We call it sigma square. And the variance of yi, that's the variance of this PT plus 1, which is sigma square, plus this error terms variance, which is sigma I square. So if we call this variance ratio of the true variation in the price divided by the variation of your signal, that measures how informative your signal is out of the true variation in the prices. Right, so if this rho is very big as 1, then your signal perfectly matches with the variation in the true price movement. If this is really 0, then you are not informative at all, right? Which means the variation in your signal is not really correlated with the variation in the true price. Right, so this rho I, or I call it beta, measures how informative your signal is. Now I can calculate the expected PT plus 1. And this expected PT plus 1 for each one, because now they have private information, so this will be conditional on their own information yi. Yi is their own signal. Right? So this expected price conditional on their own signal, that will be just the mean plus how informative your signal is times the deviation from the mean. Right? So that we can calculate what's the conditional variance of this price conditional on yi. The conditional variance will be the variance of this sigma v, which is the expectation of PT plus 1 conditional on yi, which we can calculate as 1 minus rho square sigma 1 minus this part, which is this part square, so rho square of sigma I squared. All right, so as you can see, I write here, the variance of this sigma v is just variance of 1 minus beta times the price minus beta of the error term. So once we got this, now we can plug this into our formula for demand for risky assets, right? So the demand for risky assets is now everything should be conditional on the yi. So this will be the conditional expectation, this will be the conditional variance. Conditional variance, we just calculate that's 1 minus rho I sigma square. Conditional expectation, that's mean plus rho I times the deviation. All right, so I think what's important is actually to understand the meaning of this expression. So what's the meaning of expression? If your rho I is big, remember what rho I is? Rho I measures the informativeness or the precision of your signal, okay? So if the signal is very precise, then your xi will increase, right? Which means you invest more or you buy more aggressively if you have more precise individual information or private signal. Right? And all the AI, sigma, all the other things remain the same as implication before. So by looking at this information by the individuals, we know that the demand for assets or the tradings for assets will be more aggressive if your information is more precise. So now your investment not only depends on your risk aversions, on the unconditional mean and unconditional variance, it also depends on the precision of your own signal. Okay, now we can just sum up all the individuals' demand, xi, across all the individual n individuals, right? So this will be just plugging the formula from the above, and set this demand equal to the supply. So demand equals to supply, you can solve for price, right? So in aggregate, because someone in the market will be buying the stock, someone on the market will be selling the stock, so the aggregate supply, we can just set them equal to 0. So let the sum of all the individual demand equal to 0. Then we can solve for price. And if you look at this price, it looks really, really complicated, right? But if you look at the individual components, they are actually not that complicated. So if you look at this, this is conditional expectations, right? M bar plus rho I, yi minus M bar, that's conditional expectations. And this is sum of this conditional expectations weighted by this thing, which is 1 over AI 1 minus rho sigma square, so this is the weight. So this is the weighted sum of your conditional expectations. And who has more weight? So if you have high rho, then 1 minus rho is small, right? 1 over 1 minus rho will be big. So if you have high rho, then your weight of your conditional expectation will also be big, okay? So now the price is actually weighted average of all the conditional expectations with all the information from all the agents, but the weight will be higher or weight will be smaller if you are more risk averse or you have lower precision of the signal. All right, so this is why we also say price aggregates all the information on the market, because all the information individuals have will be represented in the pricing formula. So whichever your individual rho I is, this will be incorporated in the aggregate PT. Right? So stock price indeed reflects all the information that's on the market, even if for each individual I, you only have part of the signal. Right? And this reflects more of your signal if your signal is more precise, and it reflects more of your signal if your risk aversion is low, because if your risk aversion is low, you will be more aggressively holding the stock. All right, so this is what we called the competitive equilibrium, because everything is competitive, right? So the price should be equal to the conditional price, and then we set the demand equal to supply. But actually, for each individual, you can actually do better. So here we calculate the expectation of the price not depending on all the other informations, right? Only depending on the signal you have. But as someone who's trading in the market, do you only conditional on the information you have? Or can you conditional on something else? So when you say, you know, I expect the price of Apple tomorrow to be 120, do you only consider your own information about the Apple, or do you have anything else that can help you to form your expectation of what tomorrow's stock price is for Apple? What's that? You not only can depend on your own information, you can also depend on the stock price itself. Because remember, you're sort of trying to form the expectation about the future price, right? But you can observe the current price. And your current price, this you observe, will be an aggregate of all the informations that's out there on the market. So even if I only know my own information, I cannot observe your information, but by observing the price itself, I can know something about your information. So by looking at the stock price, I already, because your stock price incorporates not only your information, but all the market participants' information, right? So my true information set should not only be my own information, but also be the stock price, which is a function of all the information of everyone in the market. All right, so this is called, remember before that we have this competitive equilibrium, which means everyone is doing the best given their own information, okay? This is called the rational expectation equilibrium, because if I'm rational, I not only need to consider my information, but I also need to consider the price itself, which is itself is a function of all the other information. So this is sort of, you know, tail wags the head, right? So this is like loop of the logic, right? So information depending on the price also depending on the information, but my information not only depends on my information, but also it depends on the price, which reflects all yours information. So now what we actually trying to solve is no longer a price. It's a price function, because it's a price function given all the informations in the market. Right. So if all the signals in the market are uncorrelated with equivariance, then the mean of all the signals will be equal to just the price plus the mean of all the signals, all the errors, right? Which means if I'm looking at the expectation of the price, observing the mean of all the signals is as good as observing all the signals themselves. Understand that, right? Because if you take the expectation here, the mean of the errors will be 0. Okay? So the expectation of the PT plus 1 is as good as you look at expectation of the YN, just the mean of the signals, which means the mean of all the signals are what's called sufficient statistics to summarize all the information that's available in this economy. So that's something, another observation. Given the information not correlated, I can actually just look at the mean of the signal instead of knowing the individual signal. So let's finish this, then we can continue on Thursday. So what we are trying to solve is the price function, right? So the strategy to solve it is to imagine or hypothesis what my price function is. So I'll assume my price function equals to some function of this mean of the signals, a linear function. And then I want to plug this assumption into the model and to solve it to see if this indeed is the correct assumption. Okay, if this indeed is the correct assumption, that means I'm actually successful, right? So with this setup, we know what the beta is. That's just covariance divided by variance, which is just rho. Because with many of the individuals, this standard error goes to 0 for the variation part. Now I can just plug in this price formula into my solution of xi. And remember, how should we set the market to be in equilibrium? We have sum of xi, which is sum of these, what we can plug in, equal to the supply, which we can set to 0. Okay, so demand equal to supply again. Then we can solve for what the price is. The price will be this m plus rho ym minus m bar divided by 1 plus r minus, this could be just 0 because xs can set to be 0. Right, so we see that with the rational expectation equilibrium, the price we solve here is indeed a function of the ym. Right, so if you go back, we start with assumption that price is a linear function of ym. Now, after we solve it, well, we find that the price is indeed a function of ym. So that means the assumption we actually take is the correct assumption for this solution. Right? So again, we solve that the price depending on the mean of all the signals, which again says that the stock price takes all the information about this stock in the market into consideration. Right? And the price fully reveals the sufficient statistical mean of all the information in the market. Okay, so I want to stop here and continue on Thursday. And I'll probably go through some of this concept again on Thursday because some of you actually don't know where we are. All right, so let's continue on Thursday.
如果是 conditional 的话，它后来的 risk asset allocation 跟你的 investment holding 是没有关系的。然后但是在是有关系的，
有关系的
这里的是没有关系的，为什么
？Predictor 是有关系的，如果是 independent 的是没有关系的。
mean reversion？
For example, follow the mean example. 是对啊，这个就是如果是 predictable mean reversion 嘛 ，mean reversion 是 predictable，那它就是有关系的，跟 horizon 是有关系的。
这个条件是 independent 的。
就没关系是 independent。